Before I get started, let me get a feel for who we have in the audience. How many business owners do we have out here? Okay, great. Capital providers, banks, funds, etc. Okay, great. Investment bankers? Excellent. Okay, and then service providers? Beautiful. Okay, so you folks can appreciate the road traveled with regard to small business financing over the past 4 years. Let's first turn the clock back to October 2007. In October 2007, the Dow Jones Industrial Average was north of 14,000. The deal-making environment was very robust. There was tons of liquidity in the marketplace, right? And the economy was generally humming along. Then this thing called the financial crisis hit, which captivated us as we watched many bank failures, including Lehman, and ultimately sent the Dow Jones Industrial Average over the next year and a half to the depths of the 6,600 range. The deal-making environment softened considerably, liquidity evaporated, and the economy was struggling. The federal government, through the American Recovery and Reinvestment Act of about $787 billion, and with the $700 billion stimulus program, the TAR program, in conjunction with the Fed through quantitative easing 1, quantitative easing 2, Operation Twist, and a reduction in the federal funds rate from 4.25% at the beginning of the recession in December in 2007 to 0, where it currently stands today, responded very aggressively. Today's a different environment. The Dow Jones Industrial Average is nearing 12,000 once again. The deal-making environment is robust. Liquidity has come back to the marketplace, particularly with regard to higher-end businesses. And in some respects, it feels like we're right back in 2007 all over again. So what I'm going to do tonight is share with you the current status of the capital markets, both from the perspective of business owners and the actual capital providers. So I'll share insights from business owners, and then we'll dig into the various capital providers, banks, asset-based lenders, and some of the other funds. And we will conclude with insights from investment bankers. So first of all, the project itself. You know, as was indicated earlier, we've really set forth to study cost of capital for small and mid-sized businesses. The project launched in 2007. We're surveying 12 segments. You learned a little bit about the certificate in private capital markets class, which will be offered next week, November 14th through 16th. So hopefully the person who's the lucky winner will be able to attend. If you are unfortunate and don't win the free certificate, if you'd like to use my last name for a discount, you're welcome to do so. You'll get $300 off. And then the current private capital markets report will be available later this month on our website. So first of all, what are expected returns by the various capital providers? We calculate this on an all-in basis. So any fees that are attributed to the deal in the instance of banks and asset-based lenders for the first couple categories are reflected here. So on an all-in basis, banks are about 5 to 7%, asset-based lending from 3 to 7%, and expected returns then for funds, for mezzanine generally, and I'm reporting on the medians here. Certainly there's some variability about these numbers, but mezzanine from about 11 to 16% are expected returns on newly deployed capital over the last 6 months. Private equity, 21 to 26%. Venture capital, 28 to 38, and then angel at the upper end of the spectrum, between about 38 and 40%, 47%, dependent largely upon size. Basically, return expectations from the last time that we had surveyed have come down pretty considerably. So let's first jump in and gain some insights into the status of privately held businesses. And as was indicated earlier, we have to thank our sponsors on this, our partners, Dun & Bradstreet Credibility Corp., who allowed us access to their large database in which we were able to collect over 10,000 responses to this particular segment. So what's going on in businesses today? First, relative to 6 months ago, and I'll do this for all the various segments that we address tonight. They're reporting basically inflationary pressures, right? Significant increases in prices of labor and materials. They're reporting that overall unit sales actually are increasing along with net income. They see plentiful opportunities for growth. However, there is a little bit of a shortening of the cash cycle. Receivables periods are receivables periods are lengthening. General business conditions are declining, and business owners are stressing about the economy. They're spending more time thinking about the economy. As for the top issues facing privately held businesses, economic uncertainty emerges at the top of the list. Okay, and to no real surprise, unemployment is still at 9% and continues to be persistently high. GDP is relatively low, a little north of 2%. Record numbers of people on food stamps, and poverty indexes at all-time highs. Second is access to capital. Okay, very important on the landscape for those issues considered by privately held companies. So what is the overall state of financing? Well, nearly 9 out of 10 businesses report having the enthusiasm to execute their growth strategies. However, less than half of that, just 49%, are reporting have the necessary financial resources, right, in order to successfully execute those growth strategies. So there's a very significant gap that exists here. We were able to ask business owners, right, what their current sources of financing are, and we segmented this in a number of ways. The graph that I'm reporting on here is that segmentation that exists for revenues of $5 million and north. So for those businesses, about half of them, right, report having a bank loan. About 4/10 of them are reporting that they have no external financing whatsoever. And then we start to look at the other categories that are largely represented by you folks here tonight. Asset-based lending at 9%, private equity at 5%, VC at 2%, mezzanine at 1.4%. When it comes to financing, we were able to gain some pretty good insights. And the major insight that we learned is that size is important. Size does matter when it comes to raising capital. And so we asked business owners if they attempted to raise capital over the prior 12 months, and as it occurred, about a third of them indicated that they had attempted to raise capital. And then we asked, what type of capital did you try to raise? And were you successful or not? And how many attempts did you initiate? And so for those businesses of less than $5 million in revenue, the average of all the categories, the average success rate is about 51%. For the $5 to $25 million revenue range, that success rate jumps to about 64%. And then as we jump above $25 million in annual revenue size, that number increases to about 83%. So the larger the business, the more accessible capital is for those. For those of you who operate in that space, obviously this makes a lot of sense to you. And it's pretty robust among the various types. For instance, banks, on the lower end, 44% acceptance rate, jumps to 72%, and then to 90% for the largest. Private equity, 23 to 44 to almost 3/4 to 74%. Okay. Also, we were able to chunk the data out a little bit, and one of the things we also learned is that location matters. Okay, we were able to separate Southern California from Northern California. And across all major categories, bank lending, venture capital, asset-based lending, private equity, mezzanine, there was basically a higher success rate for those businesses that are considered to be part of the Northern California region versus Southern California. Well, what does this mean? Well, when it comes to some of the reasons that businesses are citing for their lack of hiring, one of the items that emerges and happens to be second on a list is access to capital. And that number is higher for Southern California businesses at 45% versus Northern California at 39%. So it appears as though this relative lack of capital relative to up north, right, is having some pressure on businesses and their ability to actually hire. So what do the next 12 months look like here for privately held businesses? They're reporting a lot of the same of what they've experienced over the prior 6 months. Increases in sales, increases in income, expect their receivables periods to continue to lengthen, no improvement in general business conditions, and further increase in time worrying about the economy. Okay, so the outlook isn't all that favorable from the business owners' perspectives, but somehow they remain optimistic about future growth opportunities. Now let's take a look at some of the capital providers, and I'll run pretty quickly through banks, asset-based lenders, mezzanine, private equity, and venture capital before leaving it with investment bankers. So think of this a little bit as like you watch Chris Berman's take after the NFL games on Sunday, right? The fastest 3 minutes in football. I'm not sure what a slow 3 minutes in football is, but nonetheless, it seems as though as long as the clock is moving, it's probably equivalent to one another. But I'll do my best to get through these slides relatively quickly here. So for banks, they're reporting worsened business conditions and a lower appetite for risk, generally. Demand for loans and underwriting standards have been flat over the prior 6 months, but they're reporting increases in the due diligence efforts. Okay, they're also reporting a slight increase in the credit quality of borrowers, a very favorable sign. There's an increased focus on collateral as a backup means of payments. And when it comes to personal guarantees, not much change relative to 6 months ago, but personal guarantee coverage starts to burn off at about $5 million in loan size is what is being reported. Very competitive landscape for high quality companies. Pricing and loan structures, right, at the larger end of the market are back to pre-crash levels in many respects, covenant-like deals, very aggressive leverage multiples. So some of the leverage multiples that we're observing, and I actually picked out two segments, the first of which is business services, the second is manufacturing companies. Multiples essentially are ranging from small firms listed at about $1 million in EBITDA of about 1.5 times up to about 3 times, and these are simply the median numbers reported. Again, naturally, there's some variability that exists about these numbers. One of the things we're seeing is on the very low end of the segment, there is a little bit more action going on with lending for smaller businesses, but still some softening of multiples across some of these categories. $5 million and $25 million, it was reported there was a little bit of softening in leverage multiples, senior leverage multiples. For manufacturing companies, the same sort of story exists. A little bit of additional leverage extension for smaller businesses, but some softening again at the $5 and $25 million mark. All-in rates on cash flow loans, right, impounding all the fees over the life of the loan. Median numbers reported from about 5.3 for those larger loans at $50 million to about 6% for those smaller loans, in this case at $1 million. A little bit of a lowering of rates on the lower end of the spectrum here, again suggesting that there's a little more banking activity starting to creep into the smaller businesses, and we have some other data points to support that as well in some future slides. What's important in terms of determining who qualifies and who does not? Well, certainly the fixed charge coverage ratio is carrying the day. That's given the highest importance score on our 4-point scale of about 3.5. That number currently is at about 1.2, slight decline from last time we surveyed 6 months ago when it existed at 1.3. So what are banks expecting for the next year, next 12 months? They're expecting further demand and loans. Lending capacity of banks and SBA lending all increased. Underwriting standards and credit quality of borrowers relatively flat. They're expecting some further increases, although very slight, in overall leverage multiples. Business conditions expected to be relatively flat. No significant change from where we exist today. And increasing due diligence efforts and further pricing compression. There's been, for those of you who are bankers, there's been a lot of attention on banks and their ability to lend. A lot of discussion about the small business lending fund, the $30 billion fund, right, in which only $4 billion of it was extended and half of that went to pay back TARP. So there's enormous pressures here on banking. In fact, even this week, former President Bill Clinton was on MSNBC's Morning Joe show, and I was thrilled because he actually pulled out one of our statistics from our report and shared it with the world that morning. It happened to be on bank loan financing and the consequence of some of that pullback in terms of hiring consequences. So we're thrilled to have an endorsement from President Clinton. So what's happening with ABLs? You know, the same common themes are going to run through here for the majority of these categories. Increased demand, slight increase in standard advance rates on collateral, okay? Not necessarily in the threshold limits, but in the actual borrower averages. Compressed loan fees and spreads, increases in loans outstanding, and again, in terms of business conditions, a general softening. That story is pretty consistent. In terms of those advance rates, seeing some general increases in the typical loan across accounts receivable, inventory, equipment, and real estate. The overall thresholds haven't changed, but on the typical loan, it appears that borrowers are taking out more of an extension against their underlying collateral. All-in rates for asset-based lending, we picked out two categories here, one of which was working capital. And it appears that through the rates, the increases in rates on the low end from 7 to 9.3 and from 3.4 to 4.9 is if there's a little bit of a hesitation or reluctance to extend credit on working capital these days, probably in part because of what the business owner is saying about the lengthening receivables periods. That's having some influence there. So rates are increasing there. However, as you looked at the hard asset kind of backed loans, equipment loans, rates are actually coming in a bit. Further pricing compression here, more competitive. In terms of the valuation metrics, aside from the fact that, of course, there's sufficient collateral for the loan, the fixed charge coverage ratio, right, comes in as being the most important. And as of the fall 2011 survey, the average comes in at 1.1. All right, so what do the next 12 months look like from the seat of an asset-based lender? Expecting increases in the demand for loans. Underwriting standards slightly more stringent, but credit quality of borrowers is expected to continue to improve. Business conditions are expected to be relatively flat, no significant improvement. And the same thing on pricing, relatively constant to what we're observing today. All right, let's jump into mezzanine capital, okay? And for mezzanine, the demand is up, right, with a recurring theme from the capital providers. Seeing increased credit quality of those borrowers seeking mezzanine financing. Reported that warrant coverage is down. Deal and leverage multiples have increased. Expected returns are down due to a couple reasons. One is seeing more competition in this space, and second, longer exit times on new investments. Underwriting standards relatively constant, not much changing there. And they too are reporting a general decline in general business conditions. As to motivations for extended investments, acquisition loans emerges at the highest concentration at 31%, followed by management buyouts at 29%, and then refinancing is at 16%. Mezzanine providers are reporting that in order to make one investment, they're reviewing about 50 reported as a median business plans, having about 10 meetings, 6 proposal letters out, and 2 letters of intent. In terms of interest rates on sponsored transactions, they're coming in a bit relative to what we had seen 6 months ago. 6 months ago, it was 13% for the majority of categories. Now we're seeing the majority coming in at about 12%, dropping to 11 at 25 million, and then declining from there. Overall expected returns, however, for the various size businesses, ranging in EBITDA from 1 million to 100 million, from about 13% on the low end for an expected return to about 20% on the high end for smaller companies. Total leverage multiples for small entities, 1 in $5 million in EBITDA, the total leverage multiple is about 3.5, reported as the median. See some extension up to about 4 on the third quartile. $10 million at 4 times, $25 million at 4.5 turns. Time to exit, here's where you can see where some of the expected returns have taken some pressure. The expected time to exit on these investments has lengthened fairly considerably. On the low end of the spectrum, from about 48 to 60 months, and then on the others, we've added about 6 months on average. So most are looking to exit in 5 or 6 years. Financial evaluation metrics, the item that emerges as being the most important is the total debt service coverage ratio at about 1.2, no significant change from 6 months ago. Okay, the expectation for the next year is at about 4 and 10, report the expectation to do somewhere between 3 and 5 transactions. Another 32% report somewhere between 6 and 10. The segments of the economy that are sought most aggressively over the next 12 months, or appear to be today, business services emerges at number 1, just barely, at 22%, followed by manufacturing at 21%, and healthcare is in vogue at 14%. All right, so what's Mezzanine expecting in the next year? Increasing demand for mezzanine capital, but leverage multiples relatively flat. Reporting a slight increase in underwriting standards, flat loan fees, payment in kind, and warrant coverage, no significant change there. A fairly significant decline in general business conditions, and overall increase in the size of the industry with some additional competition from BDCs and SBIC funds. All right, so let's roll into private equity here and see what we're observing in this environment. Similar to the other capital types, increased demand for private equity, also reporting increases in the quality of companies, increased deal multiples, longer exit times. Private equity funds are starting to look for other areas to deploy their capital, so they're more seriously considering minority investments, if in fact they weren't previously, and investments that are smaller and larger than where they typically had invested. Decline in expected returns on new investment and a general lower appetite for risk, and overall, again, consistent with the others, declining business conditions. About 1 in 4 are reporting not making any transactions over the prior year. About 30% reported making 1 transaction, 17% reported making a couple transactions. And what does the deal funnel look like for private equity? Reporting on the median numbers, it's taking 100 business plans in order to get 1 deal done, 15 meetings and 5 proposal letters. As for deal multiples, seeing a little bit of an increase in multiples on the lower end of the spectrum here, $1 and $5 million in EBITDA, reporting increases in multiples from about 4 to 4.8 on the median, and 5 to 5.6. The other areas are remaining relatively constant. Equity contributions generally have come down within the capital structure across the board. Okay, so what are the expected returns for funds? Well, we broke this out into buyout and non-buyout or growth. And generally what we observed, reporting on the buyout expected returns here primarily, is that according to the most recent survey, we're looking at somewhere between 25 and 30%, relatively consistent with the range that we had captured 6 months ago, but across the board, seeing a little bit of softening in expected returns. For instance, at $5 million, a decline from about 30 to 26% expected return. At the $10 million EBITDA category, decline from about 30 to 25, and general softening in the $25 million category as well. As for exit times, pretty consistent with what we had seen previously, a little bit of an increase in some of the categories here. As for the next 12 months, the expected number of transactions, about 30% are reporting the expectation to do 2 deals, another 30% are reporting 3 deals. Segments targeted in the next year, pretty much consistent with what we saw from the mezzanine category. Manufacturing and business services at 19 and 16% respectively, followed by healthcare and then retail. All right, so what's the next year look like from a seat of a private equity fund? Increasing demand for private equity and seeing increases in the quality of companies seeking investment. More focus on perhaps taking on minority stakes. Further increases in leverage and deal multiples, generally flat to slightly lower expected returns on their new investments. And again, kind of a continued deterioration in economic conditions for these businesses, and commensurate with that, a lower appetite for risk. All right, let's hit on a few data points in the VC world here. According to VC, right, increased demand, consistent with the other categories, increased average size of investments relative to 6 months ago. Exit times actually have extended. Decline in expected returns on their new investments. And there's a lot going on in the VC segment. Seeing the emergence of super angels, for instance, and the overall industry is declining in size. They also, too, see worsened general business conditions relative to 6 months ago. Deal activity in the last 6 months, about 1 in 6 are reporting no deals, 13% reporting 1, 19% reporting 2, and then 15% reporting 3 deals. The deal funnel, reporting on medians, it's reported to take about 60 business plans in order to get one deal done. That also includes 20 meetings and 3 proposal letters or term sheets issued. Expected returns for venture capital have come down considerably since we started the study, now coming in a range of about 28 to 38% as we look at the median numbers. Still quite a bit of variability about these numbers. Number of transactions in the next 12 months, the largest concentration comes in at 21% for 3 transactions, 12% expect to do a couple, 4% expect to do 1. For segments targeted in the next year, information technology at the highest concentration of about 43%, followed by healthcare at 19, basic materials and energy at 6. So what are they expecting over the next year? Increasing demand for VC and quality of companies seeking investment. They're expecting increasing amounts of follow-on investments, increasing value of the portfolio companies, generally flat to slightly lower expected returns on new investments, and general worsening of business conditions, and a further contraction in the size of the industry. All right, so let's take a look at investment bankers. And this actually is one of my personal favorite sections because I put a lot of stock in what the investment bankers have to say. I mean, seriously, if you think about it, if you can't trust an investment banker, just who can you trust in this world? So let's take a look here. So relative to 6 months ago, we have deal flow up slightly, relatively flat multiples, both deal and leverage, extended time and increased difficulty to sell businesses, increased presence of strategic buyers, margin pressures on the companies are increasing, and again, consistent is general worsening of business conditions. As for transactions in the last 6 months, about 1 in 4 reporting having not made any transactions. Another 1 in 4 reporting 1 and 20% reporting 2. As to the time to transact businesses, from initial engagement to actual sale, about 1 in 3 are reporting a range of about 6 to 8 months, 22% are reporting between 4 and 6 months. And we asked the question, are strategics outbidding financial buyers in this environment? And interestingly, 19% said no, which naturally means that 81% indicated yes. So in terms of the size of the premiums by strategics, looking at about 28% indicating that the premium was between 11 and 20% more, about 1 in 4, 23% are saying between 0 and 10% more. 43% of engagements expired without a transaction. As to the reasons why, the item that emerged number one is a valuation gap in pricing. It still exists, followed by economic uncertainty, and one that I'm just perplexed over. I just can't even imagine a case in which this may exist, but unreasonable seller or buyer demand. As to the valuation gap, 37% are reporting a valuation gap of less than 20%. 39% report a 21 to 30% valuation gap between buyer and seller. This is where we start to get a feel for really the availability of capital relative to the businesses that are seeking capital. And so we asked investment bankers, and we also asked private equity groups the same question. Are you having a difficult time securing senior debt? And so we ranked this on a scale of -3 to 3. And what we observed is that there's a relative ease, as you get above the 0 mark, there's a relative ease securing senior debt at about $5 million in EBITDA north. Okay, pretty consistent. The PEGS is the blue line. iBankers is the orangish line here. And so there's relative ease north of $5 million. However, south of $5 million, right, it's still pretty difficult to secure any sort of debt on deals. Interestingly, relative to 6 months ago, this number switched on us, right? Anything less than $10 million 6 months ago was very difficult, as reported by both private equity and investment bankers. But now we're seeing that some of the lending and capital is moving a bit downstream towards smaller companies. We also asked both investment bankers and private equity groups what the overall balance of capital was relative to quality businesses worthy of financing. And again, we see the same sort of breakout exist at about $10 million in north in EBITDA size. There's basically more capital out there swirling around trying to chase fewer quality companies. And then as you get south of $10 million in EBITDA, is what is reported here, there's actually more quality companies worthy of financing than there is capital available to support them. So it's kind of interesting to see how this breakout existed. And because I hold the word of the investment banker in such a high regard, I decided I better ask another group just to make sure that those results were actually robust, and certainly enough that's endorsed by private equity. This might be one of the first time they actually agree on something. So as to investment banks, the next 12 months in transaction forecasts, about 23% are reporting 2 transactions, 20% are reporting 3. Almost half are reporting an expectation of between 3 and 5. So next 12 months, investment banking seeing deal flow up sharply, relatively flat leverage and deal multiples, extended time, right, to sell, and increased difficulty as well. Seeing an increased presence of strategic buyers in the space, increased margin pressure on companies, and a continued decline in business conditions. So what do we see across all segments here? One is, the common themes are there's deteriorated business conditions across all the segments surveyed. No significant improvements expected in the next 12 months. So basically where we are today is kind of what the expectation is as we look forward. Starting to see early signs of leverage and valuation stagnation and decline in some segments, accompanied with higher pricing, particularly on the smaller end of the curve for small businesses. Seeing extremely competitive conditions for quality large companies. And then for those businesses that are capital intensive, they appear to be eligible for more favorable loan pricing via ABL and are likely to see continuation with any sort of continued economic weakness. Also is a common theme, right? Longer exit times on most asset classes, right? Causing declines in expected returns, more competition. Opportunities appear to exist for investments in smaller businesses, okay, those less than $10 million in EBITDA. Debt more available than it was 6 months ago in the $5 million EBITDA segment for transactions. Also seeing increased opportunities for working capital funding, right, with receivables lengthening, inventories building, and margins compressing. and expecting continued demand for all capital types across the board. And really, I think one of the takeaways is, of course, is to, approaching investments cautiously. It's a very uncertain economic environment in which we're navigating. And folks, this is very important. As we indicated earlier, there is a shortage of capital, as at least perceived by the business owners. The lack of capital available to support deals and support growth is inhibiting firms' abilities to hire. And so we had the opportunity to ask these business owners who we surveyed, if you were to pick one policy option in 2012 that you believe that would spur job growth the most, what would that be? And number one was increased access to capital, emerging at 35%. And that actually exceeds, right, the couple items that we see on the table more frequently, which is tax incentives at 23% and regulatory reform at 18%. So keep up the good work out there. Thank you.